time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Lyle Stein. He's president at Forvest Global Wealth Management to talk about something that you've brought to us, Lyle. And this is a big divergence in debt levels in the U.S. versus Europe. We've got a graph here that we can probably perhaps begin our conversation with. You can explain to viewers what we're looking at here, and we'll move on to why it's important. This is government debt as a percentage of gross domestic product in the U.S., roughly 140%. In Europe, about 80%.
Yeah, and I was stunned when I saw this. You keep thinking of Europe being the slow growth, low growth economies in the world, which they are, and economies that had borrowed money to get through the pandemic and whatnot. Yet when you look at debt as a percent of GDP, which is the number that everybody's focusing on, I was stunned that the U.S. is 40%, 60% actually, worse than Europe. And that has interesting implications. You know, King dollar may not be so strong in a world where U.S. debt keeps going up and up and up, and there's no really indication that the U.S. debt is going to come down. No politician, particularly the two old guys, want to cut any of those entitlement programs. Interest bills are going up. If you have a lot of debt, it's a problem. And when you think about debt relative to GDP, if your debt is growing faster, if your interest rates are growing faster than the debt, it's a problem. If you have a 6% interest rate or 5% interest rate and the economy is only growing at 4%, that debt is a noose around your neck, and that's what's happening in the U.S. today. So when you look at this, it makes a much stronger case for moving assets out of North America into safer jurisdictions. Now, is Europe a safer jurisdiction? Perhaps, if you look at debt only. But it sure surprised me as to the attractiveness of Europe relative to North America.
And when you say moving assets out of North America into Europe, are you talking about equities?
Equities, debt. You know, interest rates are lower in Europe than they are today. However, they're high in the U.S. for a reason, and it's not just inflation. It's that real cost of money that we talked about earlier. And that real rate of interest has shot up because I think investors are becoming more aware of the problems from a fiscal perspective in the U.S. What was it, James Carville said, I want to come back as the bond market and punish back in the days of Bill Clinton. That's what's happening today, and it doesn't look as precarious in Europe as it does here.
But part of the reason that U.S. bond yields ran up this fall was the issuance of new debt by the U.S. government. A lot of bonds being put onto the market, i.e. a lot of supply pushed down bond prices and drove the yields up. Is that part of the story as well?
Absolutely, and it's not just supply, it's relative demand. And when you think about the demand for U.S. Treasuries over the last, let's call it 10 years, quantitative easing was frankly a market or a buyer of U.S. Treasury issues. You had China and Japan and the rest of the world buying lots of U.S. bond issues. They're not playing today. In fact, they're doing a quantitative tightening. They're selling. And just like the Treasury is now getting off its position in its quantitative tightening. So you've got this supply coming at the same time that there's reduced demand. Hence, you've seen the spike in interest rates.
One thing that higher yields have meant in the stock market is a lot of pressure on dividend-paying stocks. What's your view of the dividend payers? Are they priced at attractive levels there? I'm talking about classic dividend payers like the Canadian banks and the Canadian telcos in particular have been punished.
Yeah, and to me, I've been wondering about that. You always want to make sure your dividend is safe. You know, that's rule number one. What would cause a dividend not to be safe? And one of the issues is these companies that we just talked about, utilities and banks, have a lot of capital. They have a lot of debt on their balance sheets. And so the uncertainty of where they will be able to roll over that debt in years down the road comes front and center. The telcos perhaps are also suffering from the fact that people have less discretionary money. You know, interest rates are higher, taxes are going up, they're not going down. What do I spend on my cable bill? What do I spend on my cell phone? You're going to take a little bit of a harder look. Banks are suffering the consequences of these higher rates as well, as mortgagers have to roll over and, you know, extend and pretend. The 20-year mortgage is now a 40-year mortgage. The 30-year mortgage is now a 55-year mortgage. These are problems. And we as investors are struggling with how safe is that dividend when I look forward and I see these things that might be hitting me down the road?
You mentioned utilities. That's not a case of discretionary spending. That's companies that produce oil or gas must move it on pipelines. It's a regulated industry, so there's almost a guaranteed rate of return. But we've also seen shares of companies like Enbridge and TC Energy fall as well. Classic dividend payers with very high dividend yields now as those share prices have come down.
Yeah, and again, we talked about Terra. There are alternatives, and if you get 6% on a pipeline equity or 5% on a government bond, that government bond gives you a higher degree of certainty of receiving that dividend. We believe that these dividends, TC, Enbridge, are safe. We own them. So that's our view. But let's just say it's not as easy when we can go buy 5% GIC.
Vancouver-based K92 Mining is operating a mine in Papua New Guinea. It's a property that was once owned by Barrick. The company has had some troubles over the past year. There were some site fatalities in June. In fact, 4 deaths this year in vehicle accidents, and they have had some ramp-up delays. Stock is down a bit over the past year, down something like 20%. But Stifel says this company has a, quote, world-class mine in the making. We are joined from Port Moresby, Papua New Guinea, by John Lewin, CEO of K92 Mining. Thank you very much for coming on the show.
Good morning to you, or afternoon.
Evening here, yeah, but 5 o'clock.
Evening.
Thanks a lot for joining us. Now, just describe this mine. It's not a huge one, production of about 100,000 ounces annually. What's interesting about this mine, though?
Okay, so production this year will be around about 120,000 ounces gold equivalent, around 140,000 ounces next year. But we're busy with an expansion that will take us up, and we'll be commissioning in 2025, which takes up to about 300,000 ounces a year. And that will be followed by a further expansion, which will take us up to about 500,000 ounces a year. So you've got production right now, but with 2 stages of expansion, you're up at half a million ounces a year. So that's very much a tier 1 asset.
Oh, for sure. That's a big mine. Is it open pit and underground?
It's an underground operation. It's unusual as an underground operation in that you actually go up into it, side of a mountain, and you're mining everything above you. So gravity is working for you. Our axe is actually about 1,000 meters below the surface, the top of the mountain. So it's very high grade. It's over 9 grams per ton average, which makes it a very low cost operation as well. With current cash cost for this year at 100,000 ounces, we're running at below $700. But with the expansion, that moves to below $500, and you're all in sustaining costs below $700 an ounce.
We have seen the stock drop over the past year. Why is that?
I think it's a combination of issues. We are a production, but we're also a growth story. I think the market right now isn't as receptive to growth stories, and there are reasons for that. We've also come in right now. We'll come in probably about 2,000-3,000 ounces below guidance for the year. And of course, as you mentioned, we've had a couple of safety incidents on site. One was our exploration, one was actually on site, and they've certainly impacted us both in terms of production, but also, prior to that and even to date, we've got the best safety record in the country, one of the lowest LTIs in the region. We're in actually the bottom quartile of Australian mines, but we have had a setback, and that's certainly something which has impacted us, both performance and people within the operation as well.
They were both vehicle accidents, I think, these fatal incidents?
Well, the exploration out on the exploration site was a vehicle accident. It was on a public road, and then we had a incident underground.
Right. Tell us, would you be open to takeovers? Do you think a major would buy you if your production is going to be ramping up so much?
Look, at the end of the day, an executive team are put in there to report to the board and to do the best they can for their shareholders. And if the best that we can do for the shareholders was to accept an offer, then that is something so that we would consider. But I don't think you'd get many takers in our shareholders at the price we're at right now, because we have over 50% of our shareholders are institutional shareholders, many of them long term, and they believe in the future like we do.
I was interested to see you got a loan from Trafigura, the big trading house. I didn't know they made loans like that.
Oh, they do a lot of those. Trafigura, from our perspective, we've basically had a relationship with them since we started. We've not only just announced a $100 million loan from them, but we've also renegotiated our offtake agreement. And we have one of the best offtake agreements that you'll see in the market. That offtake agreement has actually added over $100 million to the bottom line of our Stage 3-4 expansion. It's a very competitive loan as well. And we produce one of the best quality concentrates that you can get. It's very high grade in gold. It's over 100 grams per ton gold. And currently we're running over 20% copper. So this is a really, really good high quality concentrate that's very much in demand.
We'd better jump. John, thank you very much indeed for joining us.
Thank you. Thanks for your time this morning, my time.
John Lewins, CEO of K92 Mining, joined us from Port Moresby in Papua New Guinea.
John Love is the former CEO of Oxford Properties. He's now the CEO of Kingset Capital, a private equity real estate investment company with several big notable properties under its umbrella. Today, in fact, one of those properties receiving a zero carbon building certification. John Love joins me now for perspective. Thanks so much for being with us, John.
Amber, thank you for having me.
So the location that we're talking about that got this zero carbon designation is the Fairmont Royal York. I imagine it's a lot of work to do that, but especially in this market, we're really trying to figure out what's a tier one asset versus others. I mean, is it that meaningful?
This has been a 5-year journey.
Wow.
Has 3 basic stages. First is you have to measure and understand in a very granular way your energy load. We used a Canadian startup called Circuit Meter to do that. The second is you've got to reduce your energy load. And we have done that by going to deep water cooling, and basically replacing everything else. The third is you've got to eliminate all the fossil fuels. And so this process has taken us 2 or 3 years in design, development, et cetera, 2 years in actual construction, $65 million, 70,000 man hours. It's a super cool project. But where we end today is with the only hotel certified in North America, zero carbon. So there's zero carbon from the hotel property. Quite a milestone.
It is a milestone, and when do you think others will follow?
Well, we'll see. It's an ambitious program. It takes a lot of creativity, a lot of capital, and at the end of the day, passion to make the hotel a leading property, not just in Toronto, but in Canada. You
have to expect to see a return on that capital because, of course, you're an investor. And how do you justify that? Do you expect more people will choose this hotel because of that?
Of course, there is a business model.
Yes,
in the first instance, there's a significant saving in energy costs. Secondly, it helps you hedge against any future energy increases. And thirdly, the revenue response, we'll see. We're optimistic that conferences that come to Toronto for sustainability, climate, carbon, will look to the Royal York first. We're hopeful that businesses who've made many ambitious claims about reducing their carbon footprints will choose the Royal York first, and as well for leisure travelers.
So that's kind of the hotel environment. I want to zoom out a little bit. We just showed a clip from Ed Sunshine, the founder of RioCan, your good friend, who was, talking about the public policy that he would need to see. You've been very vocal about, and really granular stuff. You're not kind of making these umbrella statements. You have really specific things that you would like to see happen when it comes to, dealing with whatever our issues are in real estate. Is anybody listening now? Like, do you find that, that politicians, policymakers are finally taking that in?
I think there's a lot of awareness on the topic. I was asked to appear before the Senate just a few weeks ago to the Standing Committee on Banking, the Economy and Commerce, and I outlined a 4-point plan that I felt was needed on the housing file. But every politician at every stripe is in full recognition that we need more supply of every kind. The challenge is, and I think the hardest part is alignment, because many great policies die in the regulations or enabling legislation. And this is where there's some heavy lifting needs to be done in alignment.
I mean, it seems like policymakers have done almost everything except the supply piece, when that seems to be the most obvious solution. I mean, we've taxed all sorts of different parts of the market.
That's because that's the most difficult piece.
Yeah.
Because what's difficult is just giving people permission. And the industry is ready, willing, and able to act and supply, but we need to take down some of the barriers.
Where are you seeing opportunities and progress on that supply side?
I think, we're starting an affordable housing project just next in the next couple of weeks in Valhalla. It's supported by CMHC. It will also be, to the best of my knowledge, the first affordable housing project that's zero carbon.
Oh.
Let me just digress on zero carbon for a moment, because I think, the carbon footprint's important to us. In our office portfolio, we have Scotia Plaza, 100 Yonge. They're the only 2 office buildings in Toronto's core that are zero carbon. We had 2 tenants come to us recently because they were looking only for a zero carbon solution, and only in those 2 buildings could they find that.
Do you notice it, like if you're a tenant in that there's something different about this, or you?
No, there's no difference in the performance of the building. But I think, a great building, where tenants are aggregating to, are buildings with what I'll call a strategy-forward process. And so that includes a great location, on transit, super core, amenitized, and the whole issue of customer sensitivity and the carbon issue, ESG, is becoming increasingly important to our office customers. And that's why you see for downtown Toronto, for example, you see the vacancy rate in the market generally is about 16%. But in the AAA buildings, which include just the bank towers, Brookfield Place and Bay Adelaide Place, and as well as our Scotia Plaza, in those buildings, the vacancy rate is only 6.7%. And there's a reason for that. Customers want best in class. They're prepared to pay. They want to attract their employees back, but they're looking for all of those elements.
All right, John, we got to leave it there. Thank you so much for that perspective. That's John Love, founder and CEO of KingSett Capital.
Well, amid an ongoing cost of living crisis and skepticism over whether carbon pricing is actually doing much to combat climate change, a new poll by the Angus Reid Institute says that 42% of Canadians would call for the tax to be abolished. For more on the survey, let's bring in Shachi Kurl. She's president of the Angus Reid Institute. Shachi, thanks so much for joining us this afternoon.
Thanks for having me.
So I thought this was really interesting. You looked even just at the sort of confusion around the carbon tax and what Canadians think they're paying or what they think they're getting back.
That's right. And this is one of those things where I think what we do have here is a bit of a failure to communicate on part of the Trudeau government. Look, the carbon pricing is supposed to be one of their marquee signature policies. But what we find is that the vast majority of Canadians either think that they don't get a rebate, and when in cases when many, if not most of them do, or that they think they are paying out more than they're getting back in that rebate. And again, we know from available empirical data how much is being paid out and how many households are receiving a rebate. But at best, there's confusion. At worst, there's just absolute misconception and misperception around what Canadians pay out and what they get back in terms of their carbon pricing. So little wonder that you have a situation now where the opposition Conservatives on Parliament Hill and across the country have just been pounding on the Liberals in government about how much people are paying, really linking it to the cost of living crisis. And as a result, without a lot of pushback, without maybe those rebate checks going out in green, glossy, sort of branded style with maybe some fact sheets attached, Canadians really don't have a sense of how this program works. And worse than that, they're starting to lose faith. There's a significant amount of skepticism around whether it even works and whether it's doing anything.
And this has really become, front and center because of this exception to heating oil that the government made. How are people feeling about that exception and about, if they weren't included in that, how are they feeling about, what's remaining?
Overall, more people think that the carve-out was the right thing to do. They support it, although that level of support, there's also a really significant level of opposition, and really that level of support is unsurprisingly highest. Nearly 3/4 in Atlantic Canada, for example, say that was something they supported. What we also see, however, is a significant amount of support for more and other carve-outs. So whether it's propane or natural gas or other home heating methods, Canadians are now, as a result of this home heating oil carve-out, which affects people across the country, but disproportionately more people in Atlantic Canada will be able to take advantage of it simply because a higher proportion use it there. So it's a higher proportion receiving that advantage. But people are now saying, well, where's my exemption? I would like an exemption too. And really, more importantly, when we look at the optics of this, because ultimately everything is political, even when it's economic,
right.
More people are inclined to think that the decision was driven more significantly by politics and trying to get support back in Atlantic Canada on part of the Liberal government than it was about providing cost of living relief.
Shachi, great to get the latest from you on what people are thinking and feeling about this carbon tax. Really appreciate it. That was Shachi Kurl, president of the Angus Reid Institute.
Well, let's talk to another market expert who's got thoughts on oil and other things as well. She's Michelle Schneider, Managing Director at Market Gauge Group, and she joins us right now. Michelle, thanks a lot for joining us. We just had a conversation on the collapsing price of crude oil. What are your thoughts on that market?
Well, Julian did a great job of covering all the fundamentals from a logical point of view, but we know that commodities aren't always so logical, and a 20% correction is not necessarily unusual given the nature and volatility of all commodities. And even though oil may not necessarily be the thing right now, we're certainly seeing that in other types of commodities like orange juice and cattle and cocoa, et cetera. So, and we had the same situation actually in gold not too long ago, where gold had this deep drop from the highs, 20%. Everybody thought gold was dead, and here we are now challenging about the 2000 level. So I mention this as a backdrop so that people understand that you can look at the fundamentals, but ultimately you have to go forward. So right now, if you go back to June, when oil was dropping down around $70 to $67 a barrel, that's when Goldman Sachs, for example, came out and said, that's it, it's in a bear market and it's never going up. And of course, we saw it go to 95. So here we are at $72 a barrel. It is possible that $72 a barrel gives it a floor. We do have demand for next week in particular that could give it a goose. We do have India coming in with strong demand. As you mentioned before, we have OPEC Plus coming up. And we still, even though tensions have eased, we don't really know what's going to happen. Of course, we all hope that nothing traumatic happens beyond what's already happened in the Gaza situation. But really, basically, we got to look at the charts, right, Paul? That's, to me, what gives me the most comfort. If we hold 72 and we can get back through $76, $77 a barrel, then we'll be looking at 80. We go through there, then obviously the fundamentals will shift. If we break down under 72, I would be looking back at around that $65, $67 a barrel. I would really doubt it would get much lower than that.
What about gold? You watch that closely as well. 2000 has been the talking point on gold for a long time now. It gets there occasionally, but never sticks. What are your thoughts on gold?
Well, gold, of course, is reacting very much to really what's going to happen here with the overall economy, with monetary policy. The geopolitics obviously has been a little bit now on the back shelf, but also really what's going to happen with just really what's the Fed's going to do in the dollar. And so I think it's being extremely patient and strong at the same time. Now we're getting any dips are very shallow. So essentially it could sit here for a while. But what it's really trying to tell you is that it's possible that as we get into 2024 with talk of the Fed easing, that's actually going to be more trouble. The money supply is so low right now. The Fed has basically ignored that. Our debt is very high. At some point, it might be the Fed that has to buy it back and print some money digitally. This is what gold is sitting and basically licking its chops, waiting for. So if it gets through 2000, maybe it'll be another false start. But at some point, when the buyers really come in at the higher levels, because gold, when it looks good, has been selling off. When it looks bad, it's been a buy. When that flips, that's when you know that gold can really hit maybe much higher levels. I'm looking at about 3,000.
Okay, in terms of equity markets, one sector you like is healthcare stocks, medical stocks, including a company called Vaxcyte, which manufactures pharmaceutical products and vaccines.
Yeah, that has been a strong stock all year. Obviously, it fluctuates along with the market, but not necessarily as strong as the market's fluctuations have been. So right now, it's been basing out at a higher level, and it looks very ripe, especially if the market holds up here, which right now, that's promising, looking at small caps. That could actually really hit much higher levels as the year goes on.
And you're watching the small cap sector as well, the small and mid caps, as reflected in the Russell 2000 index. There's been a bit of a rally there. What's that telling you?
Well, that to me is everything in terms of the whole macro backdrop of the market. I mean, obviously, NASDAQ is NASDAQ, and it's sitting there at the highs. But if we look at the range that we've had, really, the small caps have gone from about 160, if we're looking at IWM, and then it was up at 200 in July. And now we're really smack dab in the middle of that range, while NASDAQ is now at the top of the range. So what that tells you right here, how important it is for the small caps to participate. Because if they start going down from here, that will drag everything. But if they can get back up over 180 and closer at some point to the 195, 200 level, I think that's, regardless of what's going on, at least for the time being, is probably a very good sign for the entire market.
Michelle, thanks a great deal for a conversation that touched on a range of topics for investors. Michelle Schneider, Managing Director at Market Gauge Group.